no let-up as we move into February, with macroeconomic and company updates coming thick and fast. Top down, the big feature of the week is the Bank of England's first interest rate decision at the Monetary Policy Committee or MPC meeting. It's the first of this year's 8 scheduled get-togethers. Now, Governor Mark Carney is expected to leave both interest rates and quantitative easing unchanged at 0.75% and £445 billion respectively. The consensus forecast seems to be maybe for one rate rise of 0.25% this year to 1% by December. Now, one way to check out the possible direction of future policy is to look at how the vote goes, as this may give an indication of how keen the MPC is to further tighten policy by making borrowing more expensive. At the last 3 MPC meetings of 2018, the vote was 9-0 against a rate rise. And we can see here how the vote for a rise has varied over the last 5 years. The taller the bar, the more votes you had for a rate rise. With employment at a 48-year high, unemployment at its lowest since the early 1970s, and wage growth finally exceeding 3% to reach a near-decade high, you'd normally expect the Bank of England to be taking a slightly tougher line and looking at taking interest rates higher. However, Governor Carney and his colleagues keep mentioning Brexit as one explanation for the old lady of Threadneedle's studious inactivity, and softer economic data in Europe, the US and China do seem to have all central banks on alert and pondering whether policy is already tight enough. If it is, well, heaven help us, as that would be a big red flag over both just how much debt there is out there, a third more than in 2007 according to some estimates on a global basis, and how fragile the global economic recovery really must be. This next chart shows the Bank of England base rate and inflation going back to 2000. If we can't withstand higher interest rates from here, we probably all need to ask ourselves why, in my humble opinion. There'll be plenty of company commentary to keep us busy as well, with around a dozen FTSE 100 firms due to offer results or trading statements or hold their annual general meeting, and a number of FTSE 250 firms are getting in on the act as well. They include DCC on Monday the 4th of February, Ocado on the 5th, house builders Barratt and Redrow, as well as drug developer GlaxoSmithKline, Imperial Brands and utility Severn Trent on Wednesday the 6th, Compass, Smith & Nephew, strife-stricken retailer Superdry and another house builder Bellway on the 7th, and finally utility SSE and real estate investment trust Shaftesbury on Friday the 8th of February. But for me, the company really capable of causing a fuss in the week ahead is BP, and the oil major is due to release its 4th quarter results on Tuesday the 5th of February. Now, the oil price rallied above $80 a barrel in early 2018, only to then slide below 60 as the year drew to a close, amid concerns over slowing demand, thanks to slower global growth, but also worries over supply, thanks to the ongoing boom in US shale output and increased production from OPEC. Now, that oil price fall in the second half of last year rather took some of the shine off BP shares, which had reached an 8-year high of almost 600 pence in the summer. Now, the oil price does of course matter to BP because the company has expressed its confidence in its ability to hold its dividend without any bother if oil stands above $50 a barrel, and right now it's somewhere just above 60. Based on current consensus forecasts, BP offers a dividend yield of around 6.3%, based on a share price just north of £5, and it does so with dividend cover of some 1.5 times. That's a bit lower than the 2 times level, which gives real comfort, but it's a huge step up on the sub 1 times cover that BP offered in 2015, 16 and 17, when some investors were even fretting that a low oil price would force BP to reduce its shareholder distribution. This chart shows the dividend and dividend cover as defined by earnings per share divided by dividend per share over the past decade. Now, a slightly more scientific test than just earnings cover is free cash flow cover. In the 3rd quarter of 2018, for example, free cash flow of $3.4 billion easily covered dividend payments of $1.4 billion. And remember, BP's also started buying back stock as well. In other words, thus far, BP's done a pretty good job of cutting costs, pruning capex and being more efficient so it can make the most of any oil price gains. Now remember that in the 2nd quarter of 2018, BP actually increased its dividend by 2.5% to 10.25 US cents a quarter. That was the first increase since 2013. Now, beyond the dividend, watch out for comments on underlying replacement cost profitability. Upstream, exploration and production, made $3.5 billion in Q3, and downstream, refining and petrol stations, made $2.2 billion. And as you can see, the trend had been improving, especially for upstream, as you'd expect given the higher oil price. After those numbers, BP boss Bob Dudley is going to announce an overview of the company's strategy. Now, BP's already lavished more than $10 billion on the purchase of BHP's US onshore shale assets, and analysts and investors will be looking at how BP plans to invest and allocate its capital to the best possible effect. Here, you need to check out 4 things. First, capital investment. BP's targeted an annual range of $15 to $17 billion out to 2021. Second, plans for production growth and the launch of new exploration and production projects. BP had 6 new startups on the go in 2018, including projects in Russia, Azerbaijan, Australia, Mexico and Egypt. Third, look at disposals. BP did announce a plan to sell between $5 and $6 billion worth of assets following the BHP deal so it could pay down net debt. And the fourth and final point to watch is net debt. This has dropped a little from its peak to $37.9 billion as of the end of the third quarter, but gearing's right at the top end of the company's target range. It'd be nice to see that start to come down, if only to provide a buffer against any future oil price declines. Thank you for watching, and I look forward to seeing you next time.